if you're part of my newsletter, you'll know that I keep an eye on the Bitcoin miners as one of the proxies that I follow for the crypto market in general. And that's because as a UK investor, they have some very attractive value propositions. Now, I don't follow them all. There are loads of tiny cap companies, but I thought I'd provide a bit of an update since it's been a few months since I posted anything related to the miners. And the last time that I did one of these full miner recaps was back in May of 2024. Now, the way I set these out is that it's quite a high-level overview rather than a deep dive into any one specific company. Now, I may do more of those in the future, and maybe I will do some deep dives into some of them, but I've generally been saving that for my newsletter rather than posting it here on YouTube. And again, if you're part of that newsletter, you probably are aware of which of the miners that I favour. Now, before we go any further, I just want to say that this isn't an endorsement or recommendation to buy any of the companies or any of the Bitcoin miners that I mention. I'm just sharing some high-level data about the companies only. So please do your own research if you're looking to invest. And I will just disclose as well that I do own some shares in Bitcoin mining companies. So just as a quick starting point, what actually is the value proposition? Why would we want to keep an eye on Bitcoin miners if we're interested in the crypto space at all? And reason number one really is that they're a leveraged play on the Bitcoin price. So miners receive their primary income in Bitcoin, so not in dollars or pounds, and the supply of Bitcoin is fixed. So every block reward is a certain amount of Bitcoin issued. Therefore, if the Bitcoin price goes up and the miners maintain their revenue denominated in Bitcoin, their revenue goes up in terms of dollar terms or pound terms or whatever currency they're based in. So that means with no additional overheads, these miners can experience revenue increases, which can translate to increases in the market capitalization of these companies. Now, many Bitcoin miners also hold Bitcoin on their balance sheet. So for example, Marathon Digital, which I'm showing the chart here of Marathon Digital versus the Bitcoin price over the last 5 years, Marathon Digital holds over 25,000 Bitcoin at the time of recording. And that's worth around 1.5 billion US dollars. So movements in Bitcoin's price affect the value of the company just purely through the fact that it holds such a large amount of Bitcoin. So if we look at the chart on the screen, you can see that when Bitcoin has spiked in the last 5 years, as it did in say 2021, we often see a big boost in the share price for miners in excess of what Bitcoin does. And vice versa, as Bitcoin drops down, we see big down movements as well in the Bitcoin miners. So the second reason that I like to keep an eye on Bitcoin miners is that here in the UK, I can hold them in tax-advantaged accounts, which you can't do with the underlying cryptocurrency. This means that we can only look at amplifying the gains and losses because of their proxy behavior compared to the underlying Bitcoin, but we can also do it free of capital gains tax. Now, this may not be a problem for you. Your country may have ways of accessing cryptocurrency or cryptocurrency direct proxies such as ETF products in tax advantaged accounts, but I just don't have that available to me in the UK, which is why I keep such a close eye on them. So it's also worth just having a quick overview of the business model for miners, just because they are actually quite simple companies to track. The business model is very simplified compared to a lot of companies out there. And the benefit of that is that it makes them quite easy to track and quite easy to compare against each other. Now, I wouldn't normally consider tracking so many companies in a specific sector. So the way I usually work is once I've narrowed down to a sector that I'm particularly going to look at and take an interest in, I'll only pick a handful of companies to track just because of the sheer volume of information that can come out and the variances in business models that you usually get. But with the Bitcoin space, really there's lots of miners and they're all doing very similar things with not a huge amount of discrepancy between how they go about doing things. In fact, to boil it all down, Bitcoin mining is effectively an energy arbitrage play. Bitcoin miners take an energy input, they then use specialized hardware to mine the Bitcoin. Those equipment costs have a fixed capital expenditure cost, and that's a one-off cost. And then there's the ongoing electricity costs and some staffing costs on top of that. But other than that, there's very few other factors that play much of an impact in the underlying expenses for the business. So because of that, really the mining companies are looking to either minimize the hardware costs or minimize the energy costs for each unit of Bitcoin they produce. Now, typically what I've seen most of the Bitcoin miners doing is they look at the energy cost and try and lower that. So for example, lots of the Bitcoin miners have operations in places such as Texas in the US, which generally has fairly cheap electricity. Although I will say that last summer there was massive grid stress in Texas just because of the weather conditions that they had there. And so some of the miners also take part in demand response credit schemes where at peak energy times they can switch off the mining and in return they can then collect cheaper electricity later. Now, not all of the Bitcoin miners do that, but just to give you a bit of a flavor, some of the more competitive Bitcoin miners are looking at net electricity costs of around 2 to 3 cents per kilowatt hour. Some of them even slightly lower than that, but that's kind of your top end range for Bitcoin miners. So then once the Bitcoin miners have the Bitcoin, they then have two options. They can either sell it or hold it. Now, there is some that do the combination of the two, but generally they tend to fall into one of two camps. Now, obviously, each of these has their pros and cons. Selling of the Bitcoin provides better cash flow, it allows faster reinvestment, and a good example of this is Iron, which doesn't hold any of the Bitcoin it mines, it sells it all immediately, and a lot of that is being reinvested into growing very rapidly. Now, there are also some big risks to the Bitcoin mining business model, and the first is that it's really cash intensive. So you can't partake in Bitcoin mining without the energy and the hardware. They're almost like a fixed required cost. Every Bitcoin miner has these costs, and there's only certain areas where you can try and trim those down. And that's because there aren't a huge number of hardware suppliers, so there's not a huge amount of competition for prices. And again, for energy, you're really looking at having to either take part in these demand response schemes for power credits, or look at locating yourself in countries which have incredibly cheap electricity. The other problem for these businesses is that their main source of revenue, which is the Bitcoin, fluctuates a lot in price, and that's directly out of the control of the miners, so they can only keep chugging along mining. But if the Bitcoin price drops too low, then they might have no choice but to start switching off the rigs because they become unprofitable. Because of these risks, it's not uncommon to see the share prices fluctuate 5 to 10% in a given day, and even more really if Bitcoin moves a lot. Now, historically, that's meant that Bitcoin miners have just burned through shareholder value, which doesn't immediately set itself up as a good investment proposition. And the way that many of these Bitcoin miners do that is through share dilution. So instead of taking on debt, many of them will just issue new shares and do an at-the-money offering, which means they can just sell new shares at whatever the market price is to raise money. That allows them to get cash on hand, to pay staff, to build infrastructure, especially if they're one of the Bitcoin miners that are trying to hold all the Bitcoin. That means that they're betting on that the price of Bitcoin will go up, and that therefore shareholder dilution is less of an issue because the shareholders are willing to take that if the Bitcoin miners can hold a significant amount of Bitcoin. Now, since I last did this update, the water has got a little bit muddied as well, just because where the Bitcoin mining business is actually really simple, some of the Bitcoin miners have branched out into high performance compute. So this is generally linked to AI, so training artificial intelligence models or inference models. And that does make it a little bit more difficult to do an apples to apples comparison. But having said that, a lot of the largest Bitcoin miners haven't touched the area yet. So those can still be generally compared. And I'll try and point out some of the bigger players who've got involved in HPC as we go through this. So who are the big players in the space? Now, I've identified the biggest players here by market capitalization, and I've also shown two charts. So the top chart is from when I last did one of these miner update videos, and then the bottom chart is as it stands at around the time of making this video. Now, depending on when you watch the video, again, it might have fluctuated somewhat, but you can see that it's really volatile and the space moves really quickly. So it was previously the three big miners, as I called them. In many ways, they aren't the three big miners anymore. So Marathon Digital, which is at the very left of these charts, is still the biggest miner by market capitalization. But whereas CleanSpark and Riot were the next two obvious contenders to be part of the big three, you can see that the middle of the pack has really closed up on CleanSpark and Riot, especially Core Scientific, which only emerged from bankruptcy at the beginning of this year. And you'll see that they've had a really fantastic run this year. And that broadly comes down to, in Core Scientific's particular view, some of the HPC contracts that it's signed. And I'll probably leave a link in the video description below, but I did a bit of a comparison for the costs of HPC versus Bitcoin mining. And at the moment, it is more profitable per unit of electricity that you're using to do HPC, so high performance computing, rather than Bitcoin mining. And so because of that, I would say that apart from Marathon Digital, there are no longer any clear big players in the space that just do pure Bitcoin mining. And the pack really has closed up, especially around the kind of middle tier Bitcoin miners. Now, again, since I last did this update, the big loser really has been CleanSpark. So its market capitalization has fallen roughly 50%. And you'll notice that That's the general state of play for a lot of the miners. A lot of them are generally down on the market capitalization that they had 3 or 4 months ago, with some of them significantly down. And really, there's only a handful that have managed to grow their market capitalization. And the ones that have are generally the ones that have been taking part in HPC. So probably notably here, Core Scientific and Iron. And this sort of stagnation of the miners has generally coincided with a lot of sideways movement in the price of Bitcoin. And I think the fact that then we've seen falls in a lot of the miners speaks to the impact of share dilution that many of them are experiencing, because a lot of them use that share dilution to run their business day to day. And so even if the market cap stays flat, the share price can still continue to go down just because of all that dilution. Now, I track quite a lot of metrics, but there are really 3 main metrics that I look at and get interested in. The first is the book value. So because mining is an unstable business, I want the companies to have a really strong balance sheet. Now, that doesn't necessarily have to be cash on hand. It can be value of property and all the infrastructure that they own as well. But I want to know that a company can weather the downturn if the market turns south. The reason for that being that obviously the debt carries with it some kind of repayment schedule. And often those are prefixed ahead of time. So market downturns or market booms can really have negative impacts on that debt repayment if it comes at a bad time. So I also calculate 2 different variations of the book value. So first I have a book value where I exclude the value of the digital assets. And that's because some of the Bitcoin mining companies hold digital assets on their balance sheet and some of them don't. And the second book value that I calculate does include those digital assets. And that just gives me a way of comparing the Bitcoin miners on a closer apples to apples comparison. The second metric that I want is really strong growth plans. Now, ideally, those growth plans should be fully funded as well, so the cash should be on hand to fund those growth plans. Otherwise, I know there's going to be either more share dilution or some kind of debt raised by the company to help realize those growth plans. And the reason I like growth is because growth means more Bitcoin being mined, which means higher revenue, which hopefully then means higher market capitalization and ideally higher share price as well. Now, I will say that in terms of growth, I've generally looked quite short term because these miners are just lighting cash on fire effectively with the amount of dilution that they do. I'm generally looking quite short term with miners. And so most of the data for the growth that I'll present in this presentation is based on projections to the end of 2024. So really only another quarter or so of data to go before we're at that point. And really that's twofold. One is because of that short-term outlook that I have on the miners. And the second is that all of the miners give projections towards the end of 2024, whereas not all of them give projections into 2025. So that means looking at their long-term outlooks and how they're going to grow or not grow, as the case is for some of them, starts to get a little bit more difficult to compare once we get past the end of 2024. Now, I would expect most of them to start releasing more information about 2025 going forwards, especially over the next couple of months, just as we're approaching the end of 2024. And at that point, I'll probably need to reevaluate where I'm at and just take a step back and just see how my predictions, how my projections went, and if the miners actually achieved them. Now, the third North Star metric that I look at is the amount of Bitcoin that's held by the miners. Now, this is just personal preference, really. Now, I personally like to see a good amount of Bitcoin on the balance sheet. And the reason that I like to see a good amount of Bitcoin on the balance sheet is that it helps with that price reflexivity. Now, the chart I showed earlier, which had the Marathon Digital share price against the Bitcoin price, showed that in periods of increasing Bitcoin price, Marathon was outperforming significantly on the upside, and vice versa was underperforming significantly on the downside when Bitcoin's price fell. And that's partly what I'm looking for in the Bitcoin miner. Now, obviously, that approach has downsides in that the miners that sell the Bitcoin can generally have more cash on hand to reinvest and grow. And often a lot of those Bitcoin miners are more involved in the HPC side of things. So there's perhaps room for growth in other areas that's not being accounted for in my summaries that you're going to see here. And again, I've mentioned them already, but Iron is probably a really good example of this. They've got huge growth plans through to the end of this year, but they sell all their Bitcoin and they use that cash to help reinvest and build out more infrastructure. Now, just to help you assess the lay of the land before we get too far into some of the metrics that I look at, you can see here the number of Bitcoin mined each month for all the different Bitcoin miners that I track. And what I've done here is I've compared the March 2024 data with the most recent August 2024 data. And the reason I picked March is because that was the last full month before the halving. And so it gives us a really good idea to benchmark how the miners have performed since the halving. So generally, we would expect to see a 50% drop in the amount of new Bitcoin that's being halved. So we'd expect to see the red bar about 50% of the size of the blue bar. So any miners that are above that 50% ratio have gained market share. They've been able to grow quicker than the rest of the market. And those that have the red line less than half of the blue line, they're the miners that have either stagnated or really struggled to grow since. Now, most of the big miners that we look at here have gained market share, so probably notably Marathon, Riot, Iron and Bitfarms have all performed really well by this metric. Most of those also have significant growth plans for the end of the year, so there's no real surprises there. Some of them still have significant growth expected this year, so I'd probably expect those names to continue to see those red bars climb higher and higher when we compare it to the March 2024 bars. But on the other end of the spectrum, there are really some that is worth flagging up that have been struggling. So namely Hut, Wolf and Core Scientific. Now Core Scientific is a little bit of an outlier here, and it's worth just noting as well that it's not an apples to apples comparison for Core Scientific, and that's because they've signed some huge HPC deals over the last sort of 4 or 5 months since I last did an update on the Bitcoin miners, and certainly since the halving. And so I'd imagine that a lot of the drop that Core Scientific has seen is as they've dedicated some of that electrical capacity over to HPC rather than Bitcoin mining. And Core Scientific has actually been really well rewarded for that. They've seen really good share price growth on the back of that because it's given them consistent, steady baseline revenues, which a lot of the Bitcoin miners just don't have. Now, it is just worth a quick note on hash rates. So for all future projections that I use, I project out the future hash growth of the network, and I just use a really simple linear benchmark for that. So I used April to set the benchmark because that was the halving month, so it gave me sort of twofold reasons for using it. The first is that it makes it easy to see if the hash growth is trending at the pre-halving levels of growth. And second is that it gives me some numbers to benchmark future price at, because I was projecting quite a long way out into the future at that point. So on the two charts here, you can see the left-hand chart was the network hash rate as taken on the first of each month, and that's the blue bars. And then there's a red trend line there. And then what I did was projected that red trend line out from the April date. And you can see that as the months have gone by, I've just been filling in what the network hash rate has been on the first of each month. Now, I do also use a smoothed out average of the network hash rate. Otherwise, it would be, all over the place, bumpy. But what you can see is that the network hash rate in the first few months after the halving hasn't really kept up with the pre-halving trend growth. And in a way, that's quite good for my projections because I'm projecting a higher network hash rate. That means that I would be projecting fewer Bitcoin being mined by the Bitcoin miners for each exahash. So if that network hash rate continues to not grow as quickly, then the Bitcoin miners would actually mine more Bitcoin than I've projected in some of my projections. Now, this chart shows the operational mining capabilities as of the August 2024 data from all of the Bitcoin miners that I track. And I've compared that against the company's target hash rate for the end of the year, just because this gives an idea of growth and how much growth each of the companies still has to come. So I will also just note that this is the average operational hash rate, not the installed hash rate in red. So most of the Bitcoin miners give a target hash rate, and I'm assuming that for pretty much all of them, that's an installed hash rate. And different Bitcoin miners have different levels of uptime. So for example, probably at the kind of top of the pack, we've seen that CleanSpark's generally had sort of 95% uptime in terms of how much hash rate they have potentially that could be deployed to how much is actually deployed. And probably at the other end, we can see companies such as Riot, which has around 14.5 exahash of operational capacity as of August. But if all of its capacity that's currently got installed was going, it would actually have 23.5 exahash. So you can see it's massively down on what it could potentially be doing. And that's the impact of some of their other activities, such as the power credit strategy, but also ongoing problems at their Rockdale facility. So when I last looked at the data, there were really just a handful of big players. So the top players were Marathon, CleanSpark, and Core Scientific, with Riot Platforms really kind of leading the middle of the pack set of miners. Since then, I'd say that Riot and Bitfarms have been the main miners that successfully made big improvements in the hash rates. So Riot has grown operational hash by 65% since May, and Bitfarms has grown its operational hash rate by 77%. Now, the next best miner for growth in that time period is CleanSpark at 26%, and then Marathon at 19%. So we can see there's a fairly big drop-off from those top growers in the last few months. Now we can also see from the chart that quite a lot of them actually, the red lines are significantly below the blue lines. So those miners, we can expect to see significant hash rate growth coming in the final few months of the year, so long as the miners can actually achieve their targets. But don't go blindly just buying in based on potential future hash rate, because each comes with their own risks. So for example, Riot is concentrating their hash in a massive facility in Texas, whereas say Bitfarms, they have a lot of expansion planned in Paraguay, which has a love-hate relationship with Bitcoin mining. So you really need to look at the individual miners and think about where are they growing their hash rate and what are the risks for that. Now, just interestingly as a side note, I made a quick video on it a number of months back, but Riot has been attempting a hostile takeover of Bitfarms. Now that would create the fastest growing and second largest Bitcoin miner by operational hash rate if successful, and the largest Bitcoin miner by potential hash rate, as in total hash rate installed if it's successful. But at the time of recording, that's still a bit of an ongoing fiasco, so I'm going to park that to one side for now. Now, I said earlier that some Bitcoin miners just sell everything they produce. Now, there are some companies where there's reasons to do that. So, for example, Core Scientific, so as part of their plan for emerging from bankruptcy, they sell all their Bitcoin every month and use that to pay down some of their debt. Now, as I've said earlier, I personally prefer to see the Bitcoin miners hold some of the Bitcoin, just because it helps with that price reflexivity, but it's not the be-all and end-all. And you can clearly see from this chart who are the sellers and who are the buyers. But if you are looking for a direct exposure to Bitcoin, then you'll see that none of the miners really offer that in a comprehensive way. In my opinion, you'd probably be better off buying a dedicated ETF product if you have that available to you in your area. Or if you don't have that, then maybe a different proxy such as MicroStrategy, with the closest Bitcoin miner in terms of its market capitalization to Bitcoin holdings being HUT. But that's less than 40% of the company's valuation, so not necessarily that big. Now we'll just flag up BitDigital, which is the very right-hand end of these tables and charts. The numbers that I've got shown there are their Bitcoin equivalent holdings. Now, BitDigital works slightly differently to many of the other Bitcoin miners in that they also hold Ethereum, and they stake that Ethereum to earn more Ethereum in rewards. So the number that I've presented here is the Bitcoin equivalent value of their Bitcoin and Ethereum holdings put together. And because Ethereum has underperformed Bitcoin massively over the last few months, you'll see that there's been a really big drop-off from BitDigital's Bitcoin valuation holdings from around 45% of its market capitalization to only around 25%, all thanks to that. Now, going into a bit more depth about the growth plans, we can see here that the projected growth to the end of 2024, and what that means is a percentage growth, which is perhaps more useful to look at. Now, it also allows us to look at how the market is valuing hash rate at the time. And as per the previous charts that I've shown, the red line there is based on the operational hash rate, not the actual installed hash rate. And I calculate most of the valuations based on the operational hash rate, not the installed hash rate, because again, if I'm valuing the business, I want to actually know how the current business is performing, not how it could potentially perform if all the stars align for that business. Now, to try and get an apples to apples comparison, you'll see that in the top table below the chart, I've looked at the market cap per exahash, but I've stripped out the digital asset holdings for each company. The idea behind doing that is that it gives me a closer comparison of how the actual underlying enterprises are doing. And from that, we can see that generally the larger miners seem to be being valued at around $100 million per operating exahash. Now, there are a couple of outliers, probably most noticeably TeraWulf and Hive. By a lot of the metrics that I've looked at, TeraWulf actually looks really expensive. And this is probably one of the clearest examples of it, because we can see that actually TeraWulf is being valued at more than double what, say, CleanSpark is being valued at per exahash in its underlying business. And CleanSpark also has a massive Bitcoin holding as well, so should benefit more from the price reflexivity than Wolf would going forwards. And at the other end of the spectrum, we can see Hive, which looks really, really cheap by this metric, especially compared to many of its peers, being at less than $70 million per exahash. Now, we can also see from the bottom table that there's quite a lot of growth still to come from some of the Bitcoin miners. Now, especially from Riot, Iron, and BitDigital, with each of those three seeing in excess of 100% growth between now and the end of the year if they were to all hit their targets. Now, the obvious outlier there when you compare those three is Riot. So generally, BitDigital and Iron seem to be being valued at around $130 million per exahash, whereas Riot's only around 100 million. And I think that's for a couple of reasons. So first is that Riot's takeover attempt of Bitfarms, which doesn't seem to be going wonderfully when you look at all the press releases, and it seems to be dragging out somewhat. So I think there's maybe a little bit of market uncertainty happening there, which is hitting Riot's valuation. And also there's the fact that Riot's exahash that's operational every month is significantly down from their potential. So in their August update, yes, they've got the power response credit system that they take part in, but almost 40% of their total capacity was offline in August, which is massively impacting the amount of Bitcoin that they can actually mine every month. Now, part of that problem has come from its Rockdale facility, where it's had a huge outage for a significant period of time now. So maybe the valuation is also the market just showing a lack of belief in the management team because they're taking so long to get some of that sorted out. Now, because there are loads of things that drive business valuations, I've said earlier that actually the book value is one of my favorite ways for these intensive businesses such as Bitcoin miners to look at. And so you can see here I've tried to chart some of that. So this chart is based on what it would cost if you bought up the whole company, stripped it for parts, sold all the parts off separately. Now, there's a couple of things that can tell us by doing that exercise. So we can see that if a business is valued at less than its book value, then it's either been performing significantly below market expectations or that it's being mispriced by the market. Now, in theory, the business should trade at a premium to the book value because the business should provide a service or some kind of value added boost to what it's doing. And in that helps it command a premium. Take, for example, Apple. The iPhone itself, other companies can make phones that have similar specs, but people pay for the Apple brand, the Apple ecosystem, or those extra things that Apple brings that other companies can't compete on. Now, I've presented two values for the book value. So the first line is the book value, but excluding the digital assets. And that's the light red on the bar chart. Dark red is then the current market capitalization of the business. And then the yellow line is the book value, but including the digital assets held. Now, again, this data is heavily skewed by Core Scientific because of their bankruptcy plans. So I tend to just ignore Core Scientific on this analysis. But we can see that if we include digital assets, there are two companies, so Marathon and Riot, which are valued at less than the valuation of the business if you strip them for parts. Now, I think this is to do with efficiency generally. So Riot, for example, currently has around 40% of its miners out of action. Compare that with CleanSpark, which is generally up at 95% plus uptime, and that might explain some of the discrepancy between how they're performing. Now, again, TeraWulf looks like it's struggling by this metric, as some of the other metrics that we've seen. We can see that its book value, that it's trading at a massive multiple compared to some of its peers. Now, to me, that suggests that it might not experience some of the same growth as some of its Bitcoin mining peers if we do see significant appreciation in the price of Bitcoin. So that was quite a whistle-stop tour, but what are my conclusions from that data? So if you're on my newsletter, you'll know the minor positions that I have. You know that my largest position is currently Riot. I've also held positions in Iron and Core Scientific in the past, which have generally been closed now because they caught the back end of the AI hype, which saw them go up quite a few multiples, which was obviously a really great trade for me. Riot has underperformed for me compared to the other two, but it's still got really strong growth plans, which should be realized by the end of the year. Huge cash on hand, an impressive power response scheme, and that's allowed them to effectively get some of the cheapest electricity of any miner. In the short term, I don't think they'll necessarily outperform a lot of their competitors, and that's really because, for me, the management really needs to get its act together. Firstly, with the Bitfarms proposed takeover, they either need to abandon that or follow through with it in a very aggressive manner. They seem to be opting for the latter, calling a special meeting. I don't know how many of the other major shareholders they've managed to gather up to their cause, but with them almost owning 20% of Bitfarms, they probably don't need to get on board that many more shareholders to be able to force through some of the changes that they want. And from there, they could potentially make another offer to purchase Bitfarms. Now, I would say that their end-of-year exahash targets do look quite a long way off. So whilst it looks like they have significant room for growth, I had personally expected them to have built up their exahash mining facilities a lot quicker than they have done. Now, I don't know if this is poor communication on their part in terms of setting expectations for investors about when that's going to materialize, but it looks like to me that they might possibly get to their total installed exahash by the end of the year. But if it's anything like their August data and they're 30-40% down in terms of the operational exahash, then I don't think they'll see the same kind of appreciation that I'm hoping for. Now, if this is the kind of analysis that you like, and I do loads of other analysis, not just Bitcoin miners, but general financial news, then you can find more information on my newsletter, which you can find links to in the description, or you can go to riskoninvestor.com for more and sign up. It's all completely free. It's just really tracking my own portfolio, and for my own benefit, I write about things that I'm interested in. So I hope you found that useful and interesting, and hopefully I'll see you in the next video. Thanks very much for watching.